inflation is the Fed has basically indicated that they will consider rate cuts. They've been pushing it off. But now, coming into September, they don't really have a lot of excuses to keep the rates up because inflation's down. And you don't want to squeeze the economy too much with a low inflation rate because you don't want to have stagflation where there's almost no inflation, because then you start to run into really big fiscal problems, or deflation, which is really scary. Right? So, good stuff for everybody if they lower rates. We're going to get into this a little bit. Here's Yahoo Finance. They're going to talk a little bit about this because everybody's getting excited in the market.
Tomorrow, we're going to get a read on the latest inflation data. Consumer Price Index report set to be released. Whether it comes in cooler or hotter than expected, there might be a way to protect your portfolio, no matter what. To discuss this, we've got David Wagner, who is the Aptus Capital Advisors Portfolio Manager. Dave, great to speak with you here. All right, so let's put this in context, put this in perspective, where we are in inflation right now and where investors can be positioning their portfolio going into and out of the print.
Yeah, Brett, thanks for having me back. But I would say that, deflation, it's become less of a market catalyst than what it was, say, 12 months ago. But I mean, who doesn't know that? I mean, there's a lot of things out there that the market believes that it knows right now. It knows that if inflation continues to come down, that we're likely going to see Fed cuts in September. I mean, look at the Fed pricing right now. We're looking at an 80% chance of a cut in September. But let me, Brad, say that in a different way. If this CPI report is a disappointment, say we get a core number around 3.4% or higher, or a headline number at 3.1% or higher. If we get that higher than expected number, then a quick, sharp drop in stocks, well, that shouldn't be too surprising because, again, it's widely known right now that inflation is falling, and two is that the Fed is likely going to be cutting in September. Bottom line, if CPI reinforces that message, the grind higher can continue. If it refutes that message, don't be shocked if we see some type of volatility in the market over the next week or two.
And so
But he's kind of got an interesting point there, which is not just the market volatility point, which is what is the metric above what is expected that is going to be a catalyst for the Fed? And he's saying 80% is the guess rate that they're going to cut. Now, that's not a super accurate number, but it's not a bad indicator. What do the analysts think, right? And if 80% of them say, yeah, we think there's going to be rate cuts, even if it comes in a little hot, that would be fine. But if you're sitting there going, well, yeah, based on what the Fed said and what they're doing, we all think there's a good chance of that if it comes in, even if it comes in a little hot. Well, what happens when it comes in at 2.9 and it comes in below? So it comes in even colder than they thought it was. Now the Fed doesn't really have an excuse. And what they really were trying to do, which we argued was it wasn't really to bring down inflation. That was part of it, but the real excuse was they wanted to loosen up the job market because a tight job market is bad for employers because it means they have to spend more on labor. And there's a lot, and these guys got to, even the Powell, I mean, he's not terrible, but he's still got to think about that cushy multi-million-dollar job he's going to get after he leaves the Fed. And so he doesn't want to piss any of his buddies off at the Chamber of Commerce or business owners. So for him, that was probably more the goal. But what happened recently, the last jobs report came in lower than expected. So they have squeezed it, which sucks for workers, but, a little bit. But nonetheless, he doesn't really have any reason anymore to withhold. Of course, he's not going to say that because, he doesn't want to piss off his bosses either. At whatever it is, Aptus Advisors. But there's a good thing that'll come down. But I want to get to the bigger point here. Not just the market.
With that volatility, because what you're talking about there is now we've gone from bad news being good news because then, and months ago, it was, okay, that puts us further towards the rate cutting pathway and that initiating. But now bad news is becoming bad news because it's signaling that the Fed might be behind what the markets were anticipating, or we might see even a recession. I want to get your purview, your own perspective on that. And then additionally here, I mean, in my inbox this morning.
And I want to skip that because we had this argument last time. They keep doing this, and this is whenever you watch finance shows, be wary of this because they'll always do this. bad jobs report. Market tanked a little bit for a couple days because of panic. Why? Because everybody's screaming recession, recession, recession. Once again, they're like, oh, the Psalm roll kicked in, and that's an indicator of recession. Not really. Every time there's been a recession, the Psalm roll has preceded it. But every time there's been a Psalm roll, it hasn't been followed by a recession.
You know what? That's one of those sort of funny sort of logic things that people have to be careful of, not just in this instance, but in many things. You know, the relationship between things don't always go equally both directions. Right? People want to apply that logic to it, and it can be a huge mistake. And in this case, and in many cases, an expensive one.
Yeah, absolutely. And the thing about it is you're looking at, they look at like the metrics and the indicators. You got to remember too, there's got to be a story behind why it's happening. Right? So in finance, you're always trying to tell that story. Right? The market went down last week because of the jobs report. Okay? And my clients are calling me and they're asking me what happened. But as a finance person, I'm not going to tell them, well, the numbers and this and that, the jobs were down, and then CPI, and then the expectations for recession, and there's an 80% chance of Fed cutting. Nobody's going to understand what any of that means. So you have to tell a story that makes sense. And the story is this. The cut jobs, a lot of people saw that as an indicator of a recession. Now, they're probably not right because it's not how that indicator works. But there was a panic about it. It went on all the shows. They want to panic about it because it gets them more viewers. Because if I'm screaming recession, you're more likely to click on that and watch it. Right. If I'm telling you everything's good, here's where, the smart money's going. Most people get bored by that. But if I say recession...
Well, and let me throw in my 2 cents here is, man, they start screaming that and doing all that clickbait stuff, and I'm looking and seeing if any of my favorite stocks just went on sale based on everyone's panics.
Absolutely.
I'm just going to put out there, if you're people who are watching particular things, those can be really good days for you, potentially, depending on what you're watching, but, take the opportunity while people are freaking out.
Right. And so the story was there was a panic because the jobs report didn't come in as great as expected, but it still wasn't bad. And typically a recession is usually catalyzed by an event, like, I don't know, a pandemic or a housing market crash, right? Or the dot-com bubble collapse, or we're going to war after 9/11, which is going to cut off the Middle East and oil. There's always been a catalyst, something that can explain it. Recessions don't just magically happen. Something causes them, right? So until you see an event that's a spook, right? That's hard to predict. And so, I mean, I could get up and say recession. Oh, you should buy my portfolio to hedge against a recession, because that's what they're doing. At the end of the day, Yahoo Finance isn't as bad about that, but they still sell shit. But the point of the matter is, I went with my favorite indicator. If Larry Kudlow on Fox News says there's going to be a recession, he's been wrong about that every single time. That's more predictable than the Psalm rule.
That guy's got such a terrible track record. Like, why does he get to have his job still? His record is awful.
Because he says the shit they want to hear. That's all. He doesn't ever say the truth. But that's the thing. We can skip the rest of this. The good news for everybody else is this. Rates come down. Any sort of credit debt you have is going to immediately come down. Your credit card rates, because they're variable, will come down. So your payments come down. So if you want to start paying off credit card debt, now's the time to hit it while it's cheaper. Right? And get your budget in order. This doesn't mean take up a bunch of credit, but if you want to do something like buy a house here in the next year, rates going to come down. It's going to be a lot cheaper, a lot more affordable. Buy a condo. If you have a house and you bought it, good. Go ahead.
Let's jump in on that one though, for people to look out for. And I feel like a broken record because I feel like I say this frequently, but I want people to be aware of the relationship here. The rates will come down and you will be able to probably qualify for more mortgage,
Sure.
but keep your eyes peeled, because when those rates start coming down, the prices on houses start
Going up.
creeping up.
Mhm.
It's a direct relationship, and it's not one I think very many people talk about, but if you watch, people in real estate are very aware of this. And so, if you're like a first time home buyer and you're just like, looking to buy your home and now is when you're ready, obviously you're going to do that. But if you're somebody that's got the flexibility to sort of try to time things, being aware of that little factoid can get you on maybe a better end of things if you've got the flexibility.
Right. So let me give you. That's a great point. A great example of this would be, let's say, let's say 350 for a house. For single family home, basic one, right? 350. So 350 is what it's going for now, while rates are at 5.25, right? So your mortgage lending rate is closer to 6 or 7%, which is high. But let's say it comes down by half a point, the interest rates, right? With the lending rates. Well, then your mortgage rate will probably come down to like 5 or 6, because it'll feel it almost in an exponential sense. When realtors are trying to sell you the house, okay, 350, what they're doing is they're calculating what would that payment be every month. Okay, so it would be about $2,000 a month, let's say. That should be right about for 350. So about $2,000 a month. Well, that's what you can afford. That's what I'm targeting. Well, the rates are lower now, so you're paying that same $2,000 is going further, right? So now, why don't I just flip it and go, well, gee, they can still afford $2,000. The rates went down, so now at 350, what they're paying is $1,800 a month or $1,700 a month. Now let's just tack $5,000 or $10,000 onto the house, because they can afford it, and we won't jack up that monthly mortgage rate, which is what people tend to look at the end of the day. That's what they're doing, and that's how that happens. You basically get gouged. I was going to go to the other good news, which is if you bought a house in the last couple of years while rates were up, now's the time to think about refinancing. Or not now, but next month when they cut the rates.
Within the next year span of time, is going to be probably golden opportunity for refining and saving yourself some money.
Quite a bit of money. Oh yeah. So all good news, because
just you're refinancing, though, make sure you really are getting the term that you want, not just the rate, because people refinance without thinking about it and realize they've reset the clock on that loan. You're resetting the clock on that loan. Do you want it to reset to a 30-year again? Or when you refinance, they don't have to do it for 30 years, just so you know.
Right.
You can have them refinance you into the same amount of time you still have remaining. And people don't remember to ask for that.
Yeah, that's a good cut. The other thing about that is that means interest rates will be down. This is really bad for the Republicans coming into the election, because if they do cut rates, a lot of people are going to instantly see payments go down. Business loans are going to be cheaper, more available. Home loans are going to be cheaper, more available. Car loans probably not till next year. But all good news for the Democrats, because it means now more people have more money coming into an election. And if they keep doing that, were you better off now than you were 4 years ago? You mean during COVID, when we were all staying in our homes, scared shitless we were going to die?
It's going to be hard for Republicans to point at the Democrats and say, see, you're all broke because of them, when everyone's like, actually,
I'm making money now.
I'm not. Yeah, good point.
So that'll be what's going on. But